Hi, good morning smart people. Welcome back to my YouTube channel. I'm Merita Arwan and I'm going to share the 4th week lesson of corporate finance of Prof. Sembel class from IPMI Executive MBA International Business. Check it out.
The first takeaway, we are learning how to assess the healthy or not healthy of the company by looking at the financial ratios, which to given the natural level and the quality of number. As we can see that the financial ratio, there are 5 ratio groups here: profitability, liquidity, activity, leverage, and market ratio. These are the example of the ratio. And other than the financial ratio, the other factor to consider is the historical trend to ensure whether the company is getting better or worse from day to day, from the industry benchmark, which also show whether this company is above or below the average compared to the industry, and also the composition of Dupont Analysis. When we are break down into the Dupont Analysis, is actually elaborate more of the component of return on equity by looking at 3 factors. First, net profit margin. Second is the total asset turnover, and the third one is the return on asset. So it's believed that to create more of the investment value or to give more healthier of the company can be generated from the increment of the net profit margin, the increment of the TAP, and also to have more leverage or more efficiency, leverage efficiency of the ROA. The second takeaway is CAPM, Capital Asset Pricing Model. It's explained about the relationship between systematic risk and expected return per asset, in particular stock or securities. It's a bit complicated, but we want to learn it to become simpler. So we need to take the component of the formula of CAPM. As we can see here, it's the total of the risk-free asset plus the risk premium. If you can see, the risk premium is consist of market risk premium multiplied by the beta. And market risk premium is consist of the net of the expected return of market minus of the risk-free of asset. First, risk-free of asset is basically the expected return of free asset, which for Indonesia is coming from the yield of the government bonds short term, approximately 5%. And for the expected return from the market is actually looking at the historical return and risk, which is for developing country like Indonesia, it can be approximately 8 to 10%. And for the beta itself, beta means the volatility of stock versus market. It can be taken from the historically data, can be 2, 3, 4 years, so on and so forth. So the beta here can be 1 if risk of stock of a company is equivalent with the risk of market portfolio, and can be 2 if risk of stock of company is 2 times bigger than the risk of a market portfolio, and 0.5 if the risk of the stock of a company is half of a risk market portfolio. This can be seen in this example. How to calculate it? So from the expected return, let's say it can generate it into 13%. So this 13%, it should be against to the reality of the actual of the returns of the company. If for example, the actual is the 10%. So if we compare that the expected return is 13% and the actual return is only 10%, it means that the company assessment is not too good because the expected return of 10% is lower than 30%. Last but not least, the key takeaway is personal financial plan. Remember S.A.I.N.T.S principle: save and invest first, then spend. For emergency funds, which approximately of the 6 times monthly expenditure, can be allocated to reksadana pasar uang. Short term to medium term, reksadana terproteksi. Medium term investing, reksadana pendapatan tetap. Medium to long term, reksadana campuran. Long term investing to reksadana saham. And if you have still extra money, you can put here.
And that's a wrap for today. See you in the next video. Bye!